Good morning, everyone. It is October 20th. It's a Monday, and we are here to talk about stocks. We're here to analyze stocks fundamentally, and my colleague Daryl is going to look at the charts. And we've got a lot going on this week. We have earnings from a lot of companies, a lot of big companies that are starting really tomorrow. And it's going to be fairly busy for a month and a half. We have some big names this week. We have even bigger names next week. So it should give Daryl and I plenty of stocks to consider reviewing. In today's session, we're going to look at some stocks that are going to announce tomorrow. And we're just going to focus on one day because there's so many. We can't look at the week or we'd be streaming for the next 6 hours. So we'll take a look at kind of an analysis before these big names announce. And those big names that I think we could concentrate on include Netflix, GE, Coca Cola, Philip Morris, RTX, Texas Instruments, Intuitive Surgical, Chubb, 3M, and of course, any suggestions that you guys, the viewers, have. I already have one, which is KLAR. We'll mix that in probably somewhere around the number 4, number 5 spot. Good to see you, Brucey. I hope you're having a good day. And Shadow Guy, thanks so much for giving me the shout out there. I appreciate that very much. Thank you.
That's really an accomplishment, Victor. You've done a great job building your channel.
Thank you. Appreciate it. And I appreciate Shadow Guy's been a member of the channel for more than a year. He was the original first member of the channel. And I appreciate that. Pedro, good to see you. Thank you, sir. Appreciate it. I hope you're having a nice day. It looks like CRMD preliminary results. Nice. That's looking good. Very good to see. We had preliminary results. Delcath Systems had preliminary results as well. We covered that on the stream yesterday, and their stock was up 26%. So I guess companies, if they have good news, they'll put it out there. All right, so just to kind of give a tour of the market real quick, just to see what's going on. The futures look to be positive. We're going to open a little higher in about 30 minutes. Gold continues to go up. Oil continues to go down. So the cost of doing business is, if you measure energy, oil, natural gas, and things, those inputs, that's a good thing. That's a good thing. It'll help with inflation. It'll help with businesses running their businesses and so forth. And what I like to look at other areas that are a little bit ahead of us just from a world clock perspective. And it looks like Asia is nice and green. Hong Kong, 2.4%. The Shanghai up 0.63. Japan, the Nikkei is up 3.37. That's looking really good. And Europe, that looks pretty green. Man, that is a positive Monday. Now, let's balance that out with some other types of information. Now, how you doing this morning, Daryl?
Doing fantastic. Treasury rates are also down this morning in the pre-market.
So that causes bonds to go up in price.
Yeah.
Now, before we started to stream, you were sharing something that was really interesting around how October, it tends to be I guess the latter half of October tends to be a treacherous period of time when we see a lot of crashes and corrections. Would you mind kind of sharing some of the information you were telling me about?
And this week that we're starting is the weakest week of the entire year over 50-year history or so. So we're going to be possibly in for some challenges if that history kind of holds up. And then starting next week, we are entering the strongest 3-month period of the market's history.
So we have like a really weak 7 days, and then we start the best 3 months.
Yeah.
Wow. Feast or famine.
Yeah, pretty much.
All right. Well, buckle up, everybody. If we can get through
Yeah.
this coming week, we're in the home stretch.
Yep, I'm hoping so.
All right, good. Well, I'm glad I got a little bit of cash to deploy if needed. Let's see how things play out. Well, today, if we look at the futures, it looks like we're going to open in the green. So we'll see how that goes. Now we are, I'll be kind of a broken record. We are in an expensive market. I don't think I'm breaking any news. And, some areas of the stock market are priced really high. The AI trade is priced really high. I think it's going to continue to go higher just because the market wants to make money, and a lot of momentum is taking these stocks higher. And we'll see if we're going to have a day of reckoning, like the .com bubble. When it burst, it was painful for like 3 to 5 years. It's not, if we get a bubble that's too big, that's the downside is, we could have a period of time it's pretty low. But looking back and really giving my current situation is you need to take advantage of the market's energy, the market's momentum where possible. If you're an older investor like myself, you want to think about asset diversification. Okay, what if the stock market were to begin to really unravel and come down? Boy, my bonds are going to look beautiful. My really boring investments are going to look so nice because they are a foundation. It's kind of like we're not going to drop below that. And that's where I could grab resources, cash, capital to either deploy or frankly to live on, to take care of my family with. So think about that diversification and asset allocation. If you're a young person, a young investor, and you're reaping the rewards of this really great stock market for some growth areas, I don't think you need to take your foot off the gas. I think you're in the right place, doing the right things. But as you begin to look at, hey, I'd like to live off my money. I'd like to make sure that money is going to be there in 5 years, 10 years. You might want to diversify. You may want to be in really low risk assets, which is one thing that I'm not the only one thinking that way. When gold goes up, that means that people are feeling a little nervous. Hey, stock market's doing great, but let me put some money in gold. That's an alternative asset. And gold has done really well for the past year and a half, 2 years. So that's what's going on out there. Other than that, I don't think there's any big news. We have the government shutdown continuing. We're in the fourth week.
Yeah, day 20 today.
Is it?
Yep.
And I think they're arguing about a couple of things. We'll see when they settle the argument and the economy goes back, or excuse me, the government opens up again. So looks like we've got Cartel Raider. Very good to see you. Thanks for joining. And looks like Blocks for Fun. Good to see you. Good morning. All right, cool. So that's what's going on with the stock market. And let's get into earnings. So as mentioned, we're going to have some big names starting tomorrow. Today we have some earnings. The names aren't that big. No disrespect to those smaller companies. It's just that we have Netflix tomorrow, $509 billion in market cap. I've had Netflix ever since did you subscribe to Netflix when they would send you the DVDs over the mail?
Yes.
I did too. And FYI, I have, rental properties. And one of the ladies at one of the units that I own, she still subscribes to Netflix where they sent her the DVDs. This information is like 5 or 10 years old, but in talking to her, and she needed me to look at the unit for some reason, and I noticed the DVDs were on her countertop, and I said, "Hey, do you still subscribe to that?" She goes, "Yeah, that's how I like to look at movies." They go, "There you go. Netflix is still operating that business." But now they mainly stream. That's where their growth has been. Big credit to them. Back in the day, they made the switch over to streaming. And now they have been really, really rewarding investors. This stock was doubted a couple years ago, and it really rose. So we're going to take a look at Netflix, but that's announcing tomorrow. General Electric, they've been flourishing because principally, really two areas. The travels, this portion of General Electric, they are generating turbines that go into airplanes, and the travel space has been doing well, especially as we get out of COVID and people wanted to travel. That's really been a good economy. And second is these data centers are needing so much power that they are buying turbines so that they can use natural gas and generate power for that data center. Okay. Now, that business has been flourishing. They're going to announce tomorrow. We'll take a look at that. And then let's talk about Coca Cola and that beverage business, the legendary Warren Buffett being an investor. Philip Morris, it doesn't matter if we have a good economy or bad economy. People, and I would say if you have a bad economy, maybe people might smoke a little bit more. So we'll take a look at Philip Morris. I looked at this one a couple weeks ago, and it looked really good. RTX, Aerospace and Defense, not a bad place to be. Texas Instruments, Intuitive Surgical. So big names, just one big name after the next. And then we'll look at Chubb, 3M, and there was a suggestion to look at KLAR. So we've got a lot to cover. Just to cover tomorrow as a preview, that's what we're going to focus on because I can't add any more. We'll be streaming for the next 8 hours, and I don't think we want to do that to you guys. So, all right. So looking at Netflix. Netflix is a pure play streaming company that, obviously we watch movies, and they've gotten into sports. They also do other types of things. And these guys are a $509 billion market cap company with $41 billion of revenue. The P ratio is high. 51 is a little high. And forward P of 41, that's also high. And I've already looked at their growth rate. You could get similar growth rates in other businesses for a lower PE. The analysts believe that it's discounted by 9%. And this stock has been flourishing, up 70%, up 125%. But the big opportunity was way back here. Back here is when, when you buy a stock is the important decision in a stock. Now, Netflix, for some reason, the market began to think, do we really need Netflix? Is Netflix all that good? They really began to doubt Netflix. And I didn't jump in right away, but this is one that I got in at the ground floor. And boy, this was a beautiful rise in my capital. And then I ended up selling toward the end of 2024. Mission accomplished at a great, great yield. And the stock has gone higher, but, mission accomplished. This stock gave us such a good opportunity back here. And I dumped good amounts of capital. I had a little bit of feedback given by one of my members, and I appreciate the feedback. He wanted more comments around what should the position size be. So I'm going to try to comment on that aspect. on the streams and videos. Since Netflix is a very well-known company, I'm very comfortable with their business. I understand what they do. I believe in what they're doing. My conviction was really high. So I really put a lot of capital into Netflix. I put $50,000 into Netflix. And I'm glad I did so because that 50,000 quickly turned into a lot more money. And so when it comes to position sizing, it's really about your confidence level, your conviction. And that's not necessarily like a mathematical equation, like what's 5 plus 5? Well, that's 10. That's easy. No, it's you got to take in some inputs and then it's your decision. What's your comfort level? How much capital do you have? And so when it comes to allocation, I tend to be comfortable if I know this business is going to exist in 10 years. I really believe in the business. The fundamentals are real. They have great fundamentals. So that's a little comment on position within a company. When we look at Netflix, we've got revenue growth of 14.84, very good revenue growth. They did slow down. I think the market began to be concerned here when we went from 18 down to 6. But the company turned things around and they've been growing far better and growing a fairly big number. Now, one of the things that's always going to be two limits to Netflix. Not everything's rosy and perfect. First, these guys are a pure play streamer. Now, that's risky to some extent. Why is that? Well, for example, Google Alphabet, YouTube is the number one streaming platform on earth. Number 2, I think, is Netflix. And if the YouTube business were to have a bad year, have a bad 2 years, well, Google has their search business, they have their cloud infrastructure business, they have other businesses they can lean on and potentially grow better there. So that's a business that's diversified across different markets. And that's a business that's probably going to be able to weather ups and downs far better. Netflix doesn't have any other business. It's like it's streaming or bust. And that's a little risky. Not overly risky if you're number one, but can they diversify into other businesses that could give them access to growth? The other piece to it is they are a good growing business, but their gross margins are not overly high. And that's always going to be a ceiling for them. And the reason that the margins aren't, super high is they have to operate with a certain amount of cost. The other thing too is their production costs, like making movies, making shows and so forth. That could be a little expensive. And that I think is going to always keep their profits limited. And you can see that in their history, especially. They're enjoying a really good time where their profit margins are 24.5, which are terrific. Free cash flow margin of 20%. So that's really good. But if we see these fundamentals come down, you're going to see a sell-off. If you see the revenue slow down a little too fast, you're going to see a nice sell-off. I don't know that we're going to see that, but we will see. We will see what happens. Now, another big threat that I'm seeing is, I think the way that content consumers, people are consuming is now become, like with TikTok and Instagram and YouTube, we're not sitting down to watch, our programming for an hour, 2 hours. A lot of consumers want like 5 minutes. And that's just kind of like going to accelerate, especially now that you have AI. And we'll see how that evolves. But that could be a threat. So when we look at what analysts are thinking, they think 9% discount, but there are some analysts that are a little concerned saying, hey, this stock price is too high. Some analysts are like, no way, we're going to go higher. And their consensus forecast shows a really good business growing. This year they're going to grow at 17. 2026, they're going to grow at 12.87, 11%, and then 10%. These are very good numbers. If they hit this forecast, they're going to be just fine. The stock is a little expensive. If the stock price stays the same, we're going to correct that just through growth. So the numbers look really good. And the market's paying for what seems to be a real positive forecast. So let me turn it over to you, sir, and then I'll come back and show my valuation.
Okay, so just to reinforce what you said about this run up, it looks like from that low in 2022 to the peak in 2025, that was 690%. That's a beautiful thing. What I am seeing right now is they are consolidating. So they've pretty much been trading flat since I would say almost May. I don't know exactly what to think about that. They do have an implied move of 8% after the earnings. So we'll see where that takes us. That could take us up to 1292 or down to 1100 or so. Would be an 8% swing either direction. One other thing that I noticed when I was out on the 5-year chart is they don't test their 200-day very often. This is 5 years, and I see that they tested it in 2023 and once more in April of this year. So that 200-day moving average is a pretty good trend line. So let's go look at their strength moving into the earnings. They do have an RSI that's below 50. They're at 48 right now. They have a PPO that's in bearish territory. And it looks like we could have a bearish crossover. If they go down tomorrow or the next day after their earnings, then we could have a bearish crossover. Accumulation has looked pretty good over the past few months. The money flow is positive and has been since about the 19th of August. So even though that the price has stayed flat, the money flow has been bullish. So it'll be interesting to watch this one tomorrow.
Yeah, definitely. I'm glad you cover the charts because that chart basically aligns, or I'm in agreement with your charts, obviously, because it's data driven. But I'm like, yes, that I completely see what the charts are telling me in real life. In fact, let's take a look at my valuation. So, as mentioned, I think the world of Netflix. I like their business. I've been a customer for 20 plus years. I was an investor, but this stock's expensive. Just put it out there. I'm not saying it's a bad business. I'm saying it's worth $276 billion, which is worth a lot, but I don't believe it's worth $520 billion, this business. If I look at their cash flows are okay. But remember that comment on gross margins. There's just, you can't get super high free cash flows if you don't have super high gross margins. And you have these businesses like an NVIDIA that have very high margins. Voila. So this business here, terrific business. It's just when you buy and the price you buy it at is really important. That's important with any stock, but this one here is a great, great example. And I think it's priced a little too high. So that's my comment on the valuation based on free cash flows and earnings per share. Now, visiting Netflix one more time, because see, there's some things that I absolutely love about stock investing. And I love the struggle I love the trying to be forensic with data and trying to figure out, why is the market doing what it's doing? I think the market's wrong. And then establishing that, hey, I think the market's wrong and I'm willing to put my capital on the line and then watching a stock rise. This is a awesome feeling and would love to do this over and over again. And guess what? It's going to happen over and over again. More recently, not as dramatic. It happened to Google, Alphabet. And this stock too, there's another lesson. This stock came down and Bill Ackman, he made a big splash, bought billions of Netflix, big press release. Hey, I'm in it. It did cause like a little bit of a rise in Netflix. And then it began to drop and he completely got out of the stock.
Oh man.
This is the great Bill Ackman. And he got out somewhere around here. And then this happened. Now, not to say anything bad about Bill Ackman. Obviously, he's accomplished so much. It's more to give everybody on this stream that additional push that what we're doing is the right thing, which is we are investing our own capital, making our own decisions. And even the best in the business don't get it right all the time. It's not like I turn my money over to a big professional manager, which I used to do, by the way, and I was dissatisfied with the results. There's an example of where one of the best in the game, supposedly, he got schooled by the market where, us individual investors got it right. And guess what? In 2025, we've been getting it right. We've been outperforming the institutional investors. So a lot of lessons out of Netflix. We'll see where they announce tomorrow. It's after the market closes, and it'll certainly be a big attention grabber. Now let's talk about an old school company, General Electric. This is, I'm drawing a blank. Who discovered Edison? Thomas Edison. This is his company. So this is old school. This was like NVIDIA 100 years ago. They basically started, commercializing electricity. And now they do a variety of things. One of them is they produce turbines for aerospace and electric power generation and all kinds of uses. They split up GE across 3 businesses. And I think there's General Electric that they do the healthcare products like big MRI machines and that type of equipment. You have the General Electric turbines, and then you have, I think, Vernova, which is power generation. This one here is General Electric. I believe they just do aerospace and some power generation. And they're a $308 billion market cap. My wife worked at General Electric. And for a while, this stock was just getting hammered. It's not really showing it. But then it just took off. It's been doing fabulous for 5 years. So this business has really picked itself up. It's in the right place at the right time. Aerospace and defense has been good. The travel industry, more airplanes are needed because people wanted to travel after COVID. All those things are happening at the right time. It does have a high expensive PE of 41, forward P of 49. Analysts do think it's too expensive and pays a small dividend, which is abnormal. Usually when you invest in businesses like this, you're getting an adequate dividend. You maybe aren't getting the biggest dividend in the world, but you are getting a decent dividend. Decent being like 2.5%, maybe 3% on a stock that's paying a high dividend. And that's a low dividend because of that stock price going up. Now, the revenue has been expanding nicely. That looks good. And they're probably going to report a quarter. It'll be interesting to see how their revenue is growing, because my observation is travel is beginning to slow down, especially international travel. I think, like, speaking for myself, I went to Europe with my wife for 3 weeks in 2023 23. Is it 23 or 24? 23, I believe. And 20 this year we haven't really traveled a whole lot. We've been busy with stuff in near our home. And I actually supported one of my sons who had a long-term assignment in San Antonio, Texas. That was my big travel for 11 weeks. But speaking for ourselves, like we did Europe because we'd been cooped up due to COVID. I think a lot of people are doing that, but everybody's kind of checked that box and slowed international travel. So it might be that we see revenues come down because airlines are not buying as many aircraft. They're trying to do more with the aircrafts they own by getting more people into business class and first class, where they make the most amount of money. So these guys, back to the old, how are their gross margins and overall profit margins? Let's take a look. So their cash flows have improved nicely, but you see that they're not expanding a whole lot. Like I love seeing, like, if you look at like a Palantir, you look at like, these companies experiencing growth that have high margins, you just see a nice trajectory of free cash. It just keeps going up, keeps building. And we're not seeing that with GE because their margins are not really high, 31.9%. And that's a high point. In bad years, they're like, geez, 20%. It's just terrible. And their profit margin, 18.6. Now that's a good profit margin. And there's been years when they lose money. So this is just, what kind of business are we buying here? We're buying a business that doesn't make a lot of money. They have to put a lot of material costs, labor. Their factories are pretty expensive to run. So I keep myself aware of that, hey, I like the GE brand. I think they're a valuable company. They're an important company, but they're not super valuable. They are not like some of these really, really desirable businesses. And that's one thing that I keep myself grounded on, so to speak. Analysts on GE, 9 of them cover it. One analyst does feel like the stock's a little too high. They've got a price target of 210. Another analyst is at 321. And looking at the future, it's expected they're going to continue to grow. These are good growth numbers for GE. It's a big business. And earnings per share will expand. Profits will be there. But that PE ratio is just too high. This is not a super growing company. Okay. This is growth. That's good. Low margins, not good. So I'm not going to pay a high PE when I can go buy a company in a better industry that has greater access to profits, greater access to good free cash flow. Now these guys do have a strong moat. There's only a couple companies on earth that make these turbines that are then sold into certain use cases. I get that, but that's where I'm at with GE. I do have a valuation on them, but let me pass it over to Daryl to look at the charts, and then we'll come back to my valuation.
So they are extended from their 200-day moving average quite a bit. They are up today. The market's open and they are trading higher today. The 5-day moving average is moving higher. The 20-day moving average is moving higher. The 50 and the 200 are also increasing. The one thing that I see here that I would keep an eye on is we have increasing prices, but we have a bearish negative divergence in both the RSI and the PPO. So basically what this means is we reached a high here. We had very strong relative strength. And then it pulled back. The nice thing is over these, basically since April, is it hasn't really gotten below 50, on RSI below 50. You want to see it at least hold 40 and start returning back upwards. So we hit a peak here. and we had peak strength in the RSI. We pulled back and we hit another peak, but notice that the momentum, the relative strength, is not as high as it was here. We pulled back, we reached another high, and once again, the RSI was not as strong as it was here. So the momentum is not as strong, even though we're hitting higher highs. That's what a bearish negative convergence is. We haven't reached this relative strength since, even though the price has gone up 22%. So that's something you want to keep an eye on if you're anyway inclined to look at the charts. I know a lot of people could care less what the charts say, but if you do, that's something you want to keep your eye on. Not that it's going to turn against you straight away, but it will at some point.
And FYI, I was one that didn't really care about charts until I started to appreciate some of the content you produce and kind of how you go over it. And it just makes a lot of sense when you match charts with, I think, fundamental awareness, and they kind of align. You're like, hey, now charts make sense to me. So I appreciate how you cover them. I've learned a lot in the streams that we've done together.
Okay, that's good to know. And one of my missions is to give people an appreciation for charts. Fundamentals don't always work out, and technical charts don't always work out. But I think
here's a lesson to me, right? Is I think Tomas is on, and we're having a fun debate on Adobe. And fundamentally, I am 100% sure that Adobe's discounted. But guess what? The market's not buying Adobe stock. So what your chart analysis is telling me is, rather than me putting my capital into a stock and maybe waiting a year, maybe waiting 2 years for the stock to eventually begin to rally, why don't I learn from you and figure out when the market's going to begin to buy into Adobe? And then if I'm a little bit late, that's fine. I think the discount on Adobe is so good that I'd rather, lose a little bit of the upfront kind of appreciation, because I then saved my capital for a year, 18 months. I don't know how many months it's going to take. And now I deployed that capital and made money on it. But once Adobe starts to take off based on the charts, I'm in, because now I've done my fundamental analysis. I see the market's buying into Adobe, and I'm off to the races.
Exactly. So that supports the buy into strength and sell into weakness theory. Let's see where we were. We looked at the RSI. We looked at the accumulation. It still looks pretty strong. It's increasing still, and the money flow has definitely spent most of its time in bullish territory.
I didn't get that. Could you try again?
Wow.
Is that your AI app?
Oh yeah, Siri on my phone is waiting for me to. Okay. So that's all I have on
Perfect.
GE.
Thank you, sir. And looking at the valuation for General Electric, this stock, I mean, the analysts are saying it's expensive. I think it's expensive by 34%. And I like General Electric for a long time. They were probably 40 years ago. They were like one of the most respected businesses, period. Jack Welch, remember that CEO? He
Absolutely.
was like the most respected CEO, period. But they've had their problems. I think their problems, they don't have a lot of room for error when they have margins that they have to operate with. And they have businesses where they have to buy premium materials, premium alloys, and so forth. So they have a certain operating business that they have to be really, really good at executing. And if they make any mistakes, they really get punished, and so do the investors. So I tip my hat to General Electric. I think they've recovered quite well. It's great to see General Electric back. It's one of the great businesses in the US. So I am going to root for them, but I'm going to keep my capital elsewhere. And good luck to anybody who owns GE. We'll see where they announce tomorrow. Now let's talk about Coca Cola. Now, I must admit, I do not drink a lot of soft drinks. It's just, I prefer water, tea, coffee, but mostly water. And these guys somehow have been able to make a close to $300 billion business, $292 billion. And of course, one of their most famous investors is Warren Buffett. Year to date, 9.28% with a 3% dividend. Not bad. For the 1 year, not looking good. So the 1 year really changes the whole appreciation. Revenue is 47 billion, PE ratio 24, forward P of 22, and analysts believe it is discounted by 13%. When we look at Coca Cola, it's not a high growth company, or I should say, they're not experiencing any growth, just a little bit of growth, not even keeping up with inflation, and their free cash flow not looking good. Negative in the trailing 12 months. And you see that we've had a decline in these periods here, right? They were probably benefiting from the fact that, hey, in the COVID years, we were probably sitting at home and drinking more beverages, eating more snacks and so forth. And now that we're out of it, maybe people are looking for alternatives. Maybe hitting the old filtered water out of the fridge like me. And that's interesting to see how their fundamentals are really not looking good for the trailing 12 months. Their gross margins are pretty darn good, by the way, for mixing water with a couple of other ingredients and putting it in a can. Those are really good margins. We used to joke when I was with a pharmaceutical device company, one of the products we manufactured were insulin bags. If you think about that, we would sell them roughly for back then $1 a piece. And back then you can go to a vending machine and get a Coca Cola for $1 a piece. Except our product, we had to sterilize, we had FDA approval, we had like all this overhead, and we thought, man, what's the deal? How come sugar water gets sold for the same price as our really highly regulated insulin bags? Anyway, carry on. Gross margins are pretty high considering what they do. Profit margins are pretty darn good. Maybe that's why Warren Buffett really likes this business. They have a strong brand. I think their moat is all about that brand. People know Coca-Cola. They like Coca-Cola. They like drinking Coca-Cola, and they will continue to drink Coca-Cola. So that looks really good. Just the free cash flow doesn't look good at all. And analysts, we've got 13 of them covering it. They're all kind of around the same zone from $70 to $83 price targets. And they think it could go up 13%. This is a safety stock. If we have a really nice sell-off in growth-related stocks, Coca-Cola is probably going to rise nicely. They're expecting to grow a little better than they've been growing recently, but it's going to be mid-single digit, and their profits are going to expand quite nicely, bringing down the PE ratio, or the stock price will rise. So that's Coca-Cola. Let me shoot it over to you. You can take a look at the charts, and we can come back to the valuation.
Okay, so as everyone may be aware of, AWS has been having some problems this morning, and I had lost all my charts when I woke up at 2:30 this morning and was checking my charts. I didn't have any of my charts, and it was supposedly because of AWS. About an hour and a half later, they corrected the issue, but it looks like something is going on again since I last had the screen.
Oh,
So
no.
we're going to improvise, and I'll just use the stock analysis chart. I won't have all the information that I typically have, but this should work for us. So Coca-Cola dropped below their 200-day. It looks like on September the 4th, and they bottomed out on the end of September, and since have gone from 65 back to 68. Looks like they're down a little bit today. The RSI had bottomed out at around 30, about that same, well, just a little bit after it had dropped below the 200, but that's been increasing and is above the 50 line at the moment. So they're showing a little bit of strength as they move into earnings. And here we're using the MACD instead of the PPO. That's the default on stock analysis. And I didn't have time to configure it like I would normally, like I like them. But the MACD did have a bullish crossover at the end of September. And the shorter term 12-day moving average has crossed into bullish territory. So to me, that's showing a little bit of strength as they move into earnings tomorrow.
Interesting. All right. And with an expensive stock market, if we have a sell-off, you immediately see Coke and Pepsi go up. It's a good safety stock.
Let me remind everybody how I calculate the options implied move. I keep track of this on all the stocks that I own as they move into earnings. So Coca-Cola has weekly options. They also have their typical monthly options. Not every company provides weekly options, but they at least, most of them at least provide monthly options. So Coke reports tomorrow on the 21st. So you look at the options chain for the nearest options expiration closest to that. Scroll down and look for a couple of numbers here. You look for when the price is basically at the money. So they're trading at 68 and the option price at the money is 69. So you look for a couple of values here. You look for the mid price, which is the middle between the bid and the ask. And you look at that on both sides. You add those two values together. So I'm going to add 0.72 to 1.31 and I get $2.03. And then you just divide that by the at the money price. So 69. So their implied move is 2.94% tomorrow. I wanted to remind everybody how calculate the implied move.
Yeah, thanks for doing that. Yeah, Netflix, you said 8%, so bigger move on Netflix expected. And again, Coca-Cola is a safety stock, so yeah, I would agree with that. Now, on Coca-Cola, I think it's priced 26% too high. Now, if I just strictly look at earnings per share, I'm going to agree with the analyst, but earnings per share is just one part of my valuation. I want to look at free cash flows because free cash flows would tell me long-term value. And based on free cash flow, they have not been expanding it and it's actually been contracting. So it's actually priced way too high based on free cash. So Coca-Cola is not going to be in my portfolio. It would be a sell. And it's just not a lot there to be excited about. It's selling a beverage. And for some investors, it's the right idea. For me, I'd rather invest in other sectors. So that is Coca-Cola. It'll be interesting to see how they go tomorrow. Let's move on. Now, Amazon, they had that big outage, but their stock price is up. I would have thought they would be seeing a little bit of, sell off, but it looks like the market's nice and green. Apple, I think, is having some success with their iPhone sales. Meta is having a good day, although Meta's had kind of a crummy month, maybe month and a half. Google's had a really nice 2-month run. That's really done well. Nvidia's down a bit. Broadcom's up. Amazon's up, as mentioned. Tesla going into their earnings. I think they announce in 2 days, right? And they're having a nice day. So there's plenty of green to point out to. Interesting to see. And overall, the market is, wow, look at that. NASDAQ is up 1%. The S&P is up 0.77. The VIX is down. Man, this market just is gonna keep going higher. Amazing. It's year to date, we are up 14.16 on the S&P. So we're going higher, folks. And this is supposed to, historically, this is one of the most treacherous weeks. So we're not done yet. We're 21 minutes into trading for the week. So let's see what happens. All right, let's keep moving to RTX. RTX is a aerospace and defense company. They have been doing really well, 39%. It's expected that, especially like in Europe, they're going to need to buy additional defense equipment, supplies, and so forth. Over the 5 year, it's up 160%. So really nice return. And it pays a small dividend because this stock price continues to go up. So I don't know that any investor is going to complain. Hey, you took my stock from 80 up to 160. What's the deal about the dividend? I don't think any investor is going to say that. They're going to be very happy with the rate of appreciation. Market cap, 211 billion, revenues of 83 billion, and P ratio 34, which is high, and forward P of 26. It's still discounted according to analysts. Again, they're going to focus on earnings per share. And these guys have been growing. This is good growth for a big company like theirs. We're seeing a resupply of aerospace and defense equipment, and especially some organic growth out of countries in Europe and such. This company, aerospace is one of those industries, right? We all get to invest the way we want, and I've never been a big investor in aerospace because of the fundamentals behind the business. Free cash flow has not been expanding. We've been kind of flat. The business has been getting bigger, but they're not producing more cash. Okay. Gross margins tight because usually the government has a cost plus arrangement with these companies. So that's good because it's kind of safe, right? Where we get to recover all our expenses, but it's just going to keep them in a particular, it's going to have a low ceiling. It's never going to be a super profitable business. And they're going to have adequate profits as they've had in the past. But to see a stock go up 160% while having low profit margins is just, it's a situation that doesn't quite make sense to me. I'm like, I get that it's a safer industry to invest in. I get that. I get the dividend, and I think this kind of company is good for a different type of investor than the investor that I like more growth oriented, higher margins, higher cash flows. That's where I think I could see my money compound quicker. And this one here has not seen my capital because of those metrics. Now, 13 analysts cover this stock. They think it's fairly priced. It's discounted by 2%, which isn't really a big discount. They're going to continue to grow, but the growth is going to slow down. We're seeing double digits, but it's going to slow down to single mid digits. I think this is where I'd be like, man, I just don't think the stock's going to do much. If anything, I think it's going to go down a little bit because this growth rate. And I showed you the gross margins and overall profitability. So I don't know if these guys are going to have fantastic years ahead. I think they've had fantastic years in 2025, 2024, as we had that tension with Russia and other countries. So that's my overview of RTX. Let's take a look at the charts.
Okay, so I'm getting alerts that AWS is indeed down again.
Oh, man.
So that is not good news. And I had drawn a couple of additional things on RTX that I wanted to point out. So since I'm not that familiar with this chart tool, I'm going to explain it to you and hopefully you can visualize it in your mind. I drew a downtrend or an uptrend line, basically connecting all of these highs. So imagine a trend line running up that way.
Yeah.
And then I also did one on the lows, basically made a copy of that and drug it down and tried to tried to connect as many low points as I could. And what the warning sign is it broke out of that short-term trend channel.
Mm-hmm.
So I'm an owner of RTX, so this was important to me to be able to understand what's going on. But it actually fell out of that trend channel. And then over the last 3 days, it's trying to make its way back into that trend channel. Just keep in mind this is short trend. It's not like it's a 5-year trend or a 20-year trend. It's months. We're just talking months here. So anyway, that was a bit concerning. I was hoping to share that with you this morning.
Mm-hmm.
The 20-day is flattened out and it started trading below the 20-day on the Friday when we had the big drop. And it's even trading below the 50-day. Looks like it could be trading. It is trading above the 50-day today. So this is also something I notice on the S&P 500 chart is the market is struggling between the 20-day and the 50-day. So which way it breaks is going to be very important. Does it break above the 20 or continue to lose steam? And do we have lower prices even below the 50? So anyway, looks like a pretty similar pattern here for RTX. This one is kind of interesting. When I was talking about the bearish negative convergence before, here we have upward prices, but we do not have a bearish negative convergence on the RSI. So we reached a high here with a high RSI. We came down and we tested additional highs, but look at this high. The RSI is actually higher. So the momentum is higher. So this is not a bearish negative convergence, but the MACD is in a bearish negative convergence. So here we have two indicators that are disagreeing with one another. So anyway, RTX, their implied move, I've already calculated this one. So let me pull up my earnings worksheet since I own this. I already have it documented. And I did put out a video on RTX this weekend or last week. So you can take a look at that if you want any additional details. The implied move is 5.3% in the options market.
I have a question for you.
Okay.
It's this is the jumping off point, but I was curious to hear your response. So RTX is a business that's been around for a long time. So when you look at like a long-term trend, like over the last 10 years, it makes sense. But let's kind of pivot. How would you change that analysis if you had a company in a much younger industry, maybe like a fintech company that like, hey, the space didn't really exist 5 years ago. This company has been traded for 2 years publicly. How does that change in your analysis?
It doesn't really change a whole lot, actually. You can't draw long-term trend charts, but I usually only do those if I starting to see prices start falling like this over a long term. Starbucks is a good example. They fell out of a 20-year trend channel a couple of years ago, and that stock has not performed well. Nike also fell out of a 20-year trend channel. So if I'm looking at a long-term trend channel, as long as it stays within that channel, I'm pretty comfortable just holding the stock. But when it starts falling out, I get really cautious when you have 20 years worth of data. So you obviously can't do that for a company that's 2 years old. But you can look at all of the other data, RSI, you can look at accumulation, you can look at the MACD or the PPO. And those all operate the same, whether the company's 2 years old or 120 years old.
Got it. Okay. Thank you. All right. So looking at the, so that's RTX. Let me see if I have a valuation on RTX. And I don't. So I'll leave it at that on RTX. I think, aerospace, as you kind of think about, like, I'll share with you how I go about what sectors and industries I invest in. I don't invest across the board on everything. I invest in things that I can totally understand and I totally believe in. And that's how I go about it. I do have some safe stocks, but it's not in aerospace. For me, it's probably the food category. I'm in Kroger's. That's been doing great. I'm beginning to get into Procter and Gamble and Colgate Palmolive. So that's a little bit of, pick your lanes, like pick lanes that you can totally be good at, you can understand and you believe in. If you see that, hey, I don't like that business, then don't invest in it. It's like invest in businesses that you appreciate and like, and that you believe in, because you're probably going to begin to get some skill around, hey, I know when it's good to buy into, we talked about Netflix media. I know when it's good to buy into this particular industry or sector. All right. So let's go into a company that came up. It was a request by one of the members. And before I jump into that, let me say hi to everybody. Peyton, great to see you. Looks like Applovin is selling off. I've been trying to buy into Applovin, and I'm doing well with that company, so I'm going to probably buy some more shares of that. Genetic Smite, great to see you. Thanks for joining, sir. Tomas, great to see you. Thanks for the comments. Man, I hope, is Adobe up today? I hope Adobe's up today. And I'd rather be wrong. And look at that, it's up. And if it starts to have a positive trend up, I'm going to be all over Adobe. It's just, man, this stock has really just kicked my butt, frankly. I showed the Netflix chart earlier. I kept seeing it go down. It surprised me. This one here, it's been going down for a while. We'll see when it has a nice long-term trend. And once it establishes that, then I'm going to pile in. I'm going to follow Tomas into Adobe. I own Adobe, by the way. I've just been selling shares of it. All right. In Shadow Guy, great to see you. Cartel Raider. Yeah. Rest in peace, Jack Welch. Great CEO. Good to see you, Cartel Raider. And I think I've said, Peter, great to see you, buddy. Great to see you. And Stefan, very good to see you. Thanks for joining. And I think I've caught up on comments. And FYI, every once in a while I miss a comment. I apologize. I'm not the best at looking at the comments, and sometimes I miss one. So if I do, I apologize in advance. All right, so we're going to turn our attention to Klarna. And Klarna Operates as a technology-driven payments company in the United States, Germany, Sweden, and internationally. The company provides payment, advertising, digital, retail banking solutions. It offers the Klarna app that creates a holistic commerce destination experience for consumers. The company was formerly known as Klarna UK, changed its name to Klarna Group. Okay. All right, so let's take a peek at their website. This is a new issuance. They IPO'd not too long ago. And here's their website. All right. So this is a payment platform. And one of the first questions I have is, okay, do they work with Amazon? Because that's the big 8,000-pound gorilla that you have to deal with if you're ever going to be in e-commerce. And it looks like they're all over. We got eBay. Oh, here's Amazon. Very good. So no, that's Walmart. Excuse me. Walmart, Amazon, Macy's. Okay. And I guess you get special offers if you go to like the Temu. You can get 10% off. Okay. All right. Looks good. I kind of have a general understanding of what they're doing. This is a stock that went public September 10th. Now, I'll say this again, which is I stay away from IPOs. Some of the best companies, their IPO price comes out here, and they IPO and it falls 20, 30, 40%, and then long term it rises. Well, I'll just wait till it falls and then buy it at a good time. How you buy a stock is really important. So I usually this would be too soon, and it has been falling, right? So from the time they issued their stock, it's fallen 10.5%. Today it's having a good day. It's a $13.6 billion market cap, with $3 billion of revenue, no profits yet. Analysts think it's discounted. They're showing good growth, but not great growth. Okay, they're small. Their revenue, $3 billion, that's good size. And 20% growth is very good. Now, the one thing that I would put, and this is a asterisk, right, is they've only been public for a little while. Okay, so they're putting up numbers here, but they haven't gone through earnings reports where they get asked questions from analysts, and they're kind of tested. They're asked questions that make them reveal what's going on with the business. So the other thing too is they haven't had like long-term kind of growth. They had a negative year here in 22. So these numbers are good. They're just, I'm not overly confident about them because they haven't been consistently growing. All right. It's a platform play. So gross margins are really high. That's good. Very good. And profit margin isn't there because they're small. As they get bigger, they'll fix that. Free cash flows are there. And with those margins, they can create that cash flow. It's a type of business where they should cash flow quite well. All right. So at 1.3 billion, based on the type of business they are, they'd probably be worth 20 to 30 billion dollars minus debt. And I'll see if I have a valuation on them. I'm not sure if I have a valuation, but I'm not looking at the wrong category. I don't think they have any debt. They're so young. 6.74 billion, and debt is 800 million. So if they could keep that cash flow going, this is a really nice opportunity, but I would still wait. Me personally, right? I stay away from IPOs. I want to see an earnings report or two before I get really confident behind a company. Once they've been through a whole cycle, 2 cycles of issuing out their financials, answering questions, we get more data, then I might be in a better place to invest. They need to show some more consistency on growth. But overall, this is a discounted stock, in my opinion. I just don't have a lot of confidence and conviction on the stock, I'd be like, well, let's let things kind of settle down before we move too far. And I imagine you're not going to be able to show much charts on this, right?
Well, this will help answer your question that you asked me in the last chart.
Okay.
For a new company, you can just tell there's not very much to work with here.
You don't have a 10-year trend on this?
No, I don't have any kind of a trend. I can tell it's going down. I can look at the volume. It looks like the volume was incredible on the first day, but it's been declining afterwards. PPO, RSI, we do have a number on there. So by default, the RSI looks at 14 days. So as long as you have 14 days worth of data, you'll get an RSI. The MACD, the default values are 12 for the fast average and 26 for the slow average. So we do have the slow or the faster average showing, but we don't have enough data for the 26-day yet. So we don't have any data for that. So it doesn't give you a whole lot of information when it's this new, but you can see as it progresses that you'll start getting more and more information. And once they're all in place, then you can use it just like you would with GE that's been around forever.
Excellent. Thank you. And the valuation on Klarna, as expected, really nice discount based on cash flows. And frankly, if they consistently grow that cash flow, I'd probably buy this stock in 6 months, 9 months if I establish confidence and conviction in Klarna. But right now, it's just too early. They could surprise me and investors in an earnings release or two, like, oh, oops, we're not growing because now that Amazon sees that we're a threat, they're shutting us out. And now that's going to cause a big contraction in our business. I'm going to give it time. And that's where I'm at with Klarna. Thank you, Brushi, for asking about Klarna. Now, I'm going to jump to a stock that's come up a couple of times on the stream, and that's Applovin. And I think it's having a little bit of stress today. Yeah, it's having some stress. What's going on here? So this has been a very good performing stock, to say the least. Now, this stock here, it taught me a few lessons. One is don't sell out of a winner too early, because I owned Applovin. I made money. I got out and then watched it go up higher. And then I bought it again and it's gone up higher. And the market, and I sold out of the position altogether, but I pretty much left some money on the table. So then I bought back into Applovin and it's taken off. And then it's now seen a nice sell-off. Well, is that opportunity knocking on my door? Let's take a look at the valuation and see what the conclusion on Applovin is. So $190 billion business. And these guys haven't been around for a long time. Did they IPO back here? Yeah, 2021. So they've been publicly traded for 4 years. And the stock's done great. The business has really grown. Revenue, 5.74 billion. P ratio really high, but they're growing a ton. They're growing really fast. P ratio 48 for 2026. And quick comment here, maybe app selling because Fuzzy Panda. Ooh. Maybe. So Applovin, if you don't know them, they are in the ad tech space. So a lot of the ads that are appearing when you're on Reddit or Facebook or even Amazon Prime, Applovin could have a hand in that. And when we look at their revenue growth, right, this is really impressive, 79% revenue growth. And it looks like they figured something out and they accelerated their growth. So they're doing something that's just dominating. And if you look at their competitors like the Trade Desk, they're contracting. So it looks like Applovin is taking that share away because their solution is better. Customers like it more. In addition to their high growth, their free cash flow, this is what I like to see. Remember the earlier comments when I showed a company and the free cash flow is all over the place. They had a good year 5 years ago, and then it was negative, and then it was okay, and then it was good, and then bad again. These guys, it's like good, better, 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 and just going through the roof. And that's a byproduct of high gross margins, high profit margins. So you're growing really fast, making lots of money. That's a simple recipe. You're going to be really valuable, which is why they got to $190 billion of market cap. So the fundamentals look fantastic. Balance sheet's great. Analyst. It's hard to keep up with this stock. Now, one analyst is like, I'm going to hunker down. This stock's such a mispriced stock. It's worth $66. And other analysts are like, no, it's worth 860. So there's a big departure from the best of the worst. And I can understand that. Some people are believers, some are not. Growth is supposed to keep going. They're going to be a $12 billion business doing 75% gross margins, growing their cash flow. I am in. I am in on this stock. So the market is selling the stock off. Really look forward to seeing your charts. Let me show my valuation and then we'll go into the charts because that's, I want to totally lock in on your chart analysis. So Applovin discounted by 17%. Now that's not the biggest discount in the world, but it's going to enable me to buy. Why am I buying at a 17% discount? Is there's only one Applovin. I just showed you their growth. They're dominating the space. They are going to continue to dominate and drive some of the other players to become irrelevant or maybe even kind of give up and move to different types of businesses because they've been very dominant. And this space, when you think about ad tech and what we're doing, Netflix is growing really well, YouTube, Amazon Prime, you have TikTok, you have Reddit. I mean, eyeballs are on these platforms, and Applovin is going to be a part of that ecosystem that just continues to grow. They're going to go international. It's just really good stuff there. So if the market's going to give me a nice discount today, I'm going to be a buyer unless Daryl can talk me out of it. Let's see what he has to say on the charts.
Now the AWS is still having problems, so we'll continue using this chart. It is trading below a downward sloping 20. It looks like it's trying to test the 50-day, which is still upward sloping. It has in April, it did come and test the 200-day moving average, which it's done a few times over the last few months. And this is quite a sell-off here. I don't know if this pressure is going to continue. The RSI is 43, so it is below 50, so it's in bearish territory. The MACD is still in bullish territory, but a couple more days of this and we're going to be in bearish territory. So we'll have to see if it holds this 50-day or whether it drops down through that 50-day and continues. Kind of hard to tell right now.
I have questions when you're ready.
Okay.
So this stock here specifically has kind of really punished. And I'm going to share my screen so I could give you a visual. So this thing sold off, and this was a hard sell off. Now the news that's out there is they're using data, user data inappropriately, and put a period on that. Similar story was being told about Facebook and Meta. And Meta, to some people, it's a very bad brand because they feel like, oh, they're using all our data. But man, everybody has our data. My wife and I, in a car we have, it's our family car. She uses an app in the car and it knows everything about us, right? And you go to your phone has all your data. I mean, everywhere you go, right? Like your bank has all your data. Everybody's got all your data. So Applovin is using the data. Okay. Now, should it be like, oh my God, they're, committing a giant crime? I don't think so. But the point I'm going to make is every time this stock pulls back, investors that sold have been punished. Down, punished. Down, punished. Down, will there be punishment? Okay. So my question to you is that anything you observe? Anything that what I'm saying that would come into your process?
I do watch those short sellers, and I watch the legal issues. UNH is going through that as well, so I get cautious when I see those. But a lot of times they don't play out in the long run. So in that case, I think it's good to still just watch the charts and see what the market is doing with that stock.
Yeah. Perfect. Okay. So Applovin, I am going to buy today. I'm good buying it and accumulating that stock. I'm not going to be surprised if this ends up being like another high. I just, I try not to get discouraged, but I kind of wish it would have just held my shares. I don't wish very often. I'm just glad I'm back in the stock, and I'm like, you know what? I'm going to hold these shares, and today is a good opportunity to buy them. There's only a couple of businesses out there that give me access to this type of growth, 79% on a big number, with these margins and this consistent increase of cash flow. There's only a couple businesses out there that show up with this type of value, this type of potential. And this is one of them. So stock market's doing me a favor today. I'm going to buy more shares. That's Applovin. Thanks for bringing it up, guys. That's what I love about streaming and hanging out with investors is they give me awesome tips. Mike, the dividend investor guy, have you looked at CRM today? I heard that they're doing well, right? CRMD. Yeah. Okay. We're off to the races here. 15.91%. Boy, this chart's up and down, huh? Year to date looks good. And these guys, I think they preliminary third quarter results, the revenues more than 120 million. Now, the thing on CoreMedix that I think it's a small cap, so it's certainly moving a lot today. And the revenue 121 million. But the piece that was a little bit concerning to me, I think from memory, was their longer term forecast is a little bit scary to me. Next year, they're going to keep growing. But if they stop growing, how will investors treat this stock? Okay. And when you look at the price action on the stock, I don't think I'm the only one, seeing that. So I would say that, it's great that it's having a good day. I would just be curious to hear what your long-term hold strategy is going to be on CoreMedix, because if it turns into a slow grower, I think it could, the stock price could come down or maybe not perform very well. And this growth in the outer years, like we're going into 2026, we're late in 2025. So this number is in, right? But once we get 12 months ahead and start looking at this number, and if they're guiding or if the market believes they're only going to grow at 6%, how will the stock behave at that point? That's one of the concerns that I have. I can calculate a discount, but that concerns me. That would be one concern I have on CRMD. But today it's having a really great day. I hope, Mike, you own a ton of this stock. You're making lots of money. And I'm not in CRMD. And overall, I think within it's discounted. Like I said, you can calculate a discount on this stock. But my confidence in the business with that long-term growth, it concerns me. It's like, why aren't they going to grow past, basically 16 months from now? What is out there that's going to basically stop them from growing any further? That's my concern. Just a broader, comment I'll put on med device, biotech, small cap, healthcare, pharmaceuticals. I think it's a great place to find long-term value and long-term compounders. I had a comment from a member of where he, I'm going to put it in my own words, which is, where could we find nice compounding investments outside of tech, healthcare, biotech? Because these businesses like this one here is, growing really fast. I'm not going to cite that number because they just, I guess, got to the commercial stage of their product and they're growing fast. Awesome. But what you will be able to find in these companies is high margins, high profitability, high growth, high cash flow. Bingo. And if you find the right one that's going to have a nice 5-10 year growth pattern, that's going to be a compounder like Catalyst Pharma, United Therapeutics. This one looks like it's having an awesome day. Hopefully it keeps going up and rewards investors that are owning the stock. Any charts on CoreMedix?
Yeah, so they look to be pretty volatile, which you have to expect in a small cap like this. They're up, trading above a 20-day and a 200-day. They did actually reach above the 50-day, but they pulled back. Looks like they haven't quite pulled back to the midpoint of this, so if it can close above that midpoint, that'd be pretty positive news. If it closes below the midpoint of this candle, then this could be a short-term bounce. The RSI did cross back above 50 after being below 50 since September the 4th. The MACD is in negative territory, bearish territory, but the shorter term average did cross above the longer term average as of today. We'll see. I'll be watching this candle. It's not one that I own, but I'll keep watching this candle through the day and see if it closes above the midpoint or below the midpoint of this range here. And that'll tell me whether the propensity is to go up or down tomorrow.
All right. Thank you, sir. And it looks like we have another request, which is to take a look at S, which is, I think, SentinelOne. This is a cybersecurity company. It's a smaller company, and I think they're growing their top line well. The stock 5-year doesn't look good. And when did they IPO? IPO June 30th, 2021. Remember those comments I made earlier in the stream? I think it was around Klarna. Is that, hey, these IPOs, they could be a terrific business, but then they tend to sell off quite harshly. And here's another example. But looking at the 1 year, this one's down 35% year to date, down 23%. Is this an opportunity, right? So let's take a look right now. So I think cybersecurity is a great place to make money. I've certainly made money in cybersecurity. Great. I'm not in SentinelOne, by the way. I'm not an investor. Market cap, 5.73 billion. Revenue, $907 million. Forward P of 67. Analysts think it is discounted. We have good growth on a small business. Now, that's good growth. The one thing I would say is within cybersecurity, the benefit we have as investors is we have a good number of peer companies where we could say, okay, there's 6 to 10 choices on an investment for cybersecurity. So then you can compare metrics like, hey, which one's giving me the best opportunity to go up in value? And that's what we'll be able to do with SentinelOne. And the revenue growth is good, but I could show you probably at least 5 other companies that are growing that well from a percentage standpoint. And those businesses are bigger. So they're bigger enterprises growing at a faster rate. So putting that in that context, it's not a great number. Margins are terrific, right in line with their peers. Their peers have those kinds of margins. Cash flow is there. Looks good. $40 million of free cash flow with the growth rate that they have. You're probably looking at a business that's worth 1.2 to 1.5 billion minus debt. And I'm willing to bet that they do not have any debt. They probably have some cash left over. Most definitely, they have about 800 million. So yeah, you're looking at, this is a 1.5 to $2 billion market cap value business. And they're way above that. So right now they're small. That cash flow figure isn't all that great. So I may not be able to get to this valuation. The forecast, analysts think it's discounted. 27 analysts are all over this stock. This is a small cap. For some reason, they think they got to pay attention to this company. The growth is going to persist nicely. Very good. And they're going to become profitable. And if they they're looking at these profits. These profits are going to expand. Looks good. Their PE ratio is going to drop unless their stock price rises from here. Now, the stock has not been working, right? For the 1 year, for the year to date, for the 5 year. And when we look at, let's see if I have a valuation on SentinelOne. I may not have it, but no, I don't. I do have valuations on CrowdStrike. CrowdStrike's priced a little too high. Zscaler, I made good money on Zscaler. Picked it up from a nice low point and rode it up. I think Rapid7's out there. This is the investment that I'm currently making is Fortinet. I think it's discounted. Let's compare SentinelOne to Fortinet. And remember, you could probably remember the the growth rates and so forth. So this is a much bigger business growing at 14%. SentinelOne was less than $1 billion in revenue. These guys are 14% growth on that bigger number. When we look at the quarterly numbers look good, consistent with the annual. And these guys are terrific cash flow. I'm going to harp on this again. When you look at the growth in cash flow, this is consistent expansion of cash flow. When you show me data like this, I'm confident that it's going to continue to go up. They're showing a growth trajectory on cash flow. So I like that. Gross margins, 81%. So that looks really good because they're bigger than SentinelOne. Profit margins, 30%. Sign me up. You're going to pay me 30% profit? I'm in. So this one here, I think, is an opportunity for me. The market has really brought down the price. And I made money on on other other cybersecurity stocks. So this stock here, I think, is providing a good stock price, and it's discounted. So this is my choice within cyber. I know some people are believers in SentinelOne. I know of at least one other person that's interested in SentinelOne in the community, believes in SentinelOne. And, I'm not going to argue with it. I think if they continue to grow and they really improve that free cash flow rate, yeah, their value is going to really go up. For now, I wouldn't invest because it is a riskier stock. It's smaller. It has plenty of competition, right? You've got CrowdStrike, you got Fortinet, you got Zscaler, you got a bunch of different businesses. And Zscaler was a stock that I was trying to remember. And Zscaler, the market treated in a way that created an opportunity. You see where Zscaler is sold off, especially from here to here, right? The market was like, man, this terrible company, horrible, right? And it really rose. And then I picked it up around here. The market sold off Zscaler by 38%, but I was seeing terrific fundamentals and rock and roll. The stocks really flourished, made some money. I sold out of Zscaler. I probably sold out a little too early, but I jumped ship and moved on to Fortinet. And we'll see if Fortinet can do the same thing that Zscaler did for me. Making money is always a good idea. All right, Mike has both SentinelOne and Fortinet. So we'll see where those go. But, cybersecurity is a good place to make money. It's when you have this type of volatility, let's use it to our advantage, man. If you see fundamentals that are terrific and you can take advantage of a market that is selling off for a reason that you don't agree with, you don't understand, like Applovin, are they the first company to ever be criticized for how they use user data? No, they're like company number 500. Google has been criticized that, oh, look at all the data they hold. And some businesses, like, for example, the credit rating agencies, they're hacked all the time. So it's not like, oh, Applovin's the only company in the universe that is holding user data, using it. Just about every business is holding user data now. And not to completely disrespect the need to have good practices there. It's just those short sellers, I think, have a fairly weak position to short a stock. I think they're nuts. So these guys are down 21%. I think it's an opportunity knocking on my door. All right. So we covered SentinelOne. Thanks for asking. I'm going to jump to, is there a stock you wanted to cover, Daryl?
RTX we already covered.
Okay, perfect. So one stock that came up in my stream yesterday that looked terrific yesterday, but then on the chat, I was told, hey, they gave up all their gains, was this one. And I thought, and yesterday when I looked at the stream, this stock was up 26%. Obviously, yesterday was Sunday. The market wasn't open. And I'm like, man, the fundamentals look terrific. I'm going to wait for this thing to settle down, and then I'm going to buy the stock because it looks really good. Let's take a look at the fundamentals, and then we'll get into the stock and where it's at, because Applovin is looking good. Look at this stock here. So this fundamentally, this is a good looking business. These guys do a treatment for people who have liver cancer. It isolates the treatment to that organ, and it's growing really well. Discounted. And let's take a look at their fundamentals. These guys have been traded publicly for, it looks like they've been around for a while. Yeah, they've been around for a while. And more recently, they were working on this treatment, and now they're really growing. These numbers are not usable because they just went commercial with their treatment. So they're really growing nicely. Sequentially, they're going, 11, 15, 20, 24, and they pre-announced their performance ahead of their earnings, which I think happen in 2 or 3 weeks. Yeah, 3 weeks from now. And that pre-announcement caused a positive stir. So preliminary is a little better than what was being projected on stock analysis. So that looked good. This is a tiny cap, 388 million, $70 million in revenue. PE is really high, coming down fast. Analysts have 120% discount. Wow. Okay. Don't see that every day on every stock. And let's take a look at other things like, okay, they're beginning to cash flow, and that cash flow on their preliminary results is coming in better than that. Margins, terrific. Gross margins. For now, they're tiny, so they don't bring down a lot of profit, but as they get bigger, that's going to become a nice, big, profitable business. Their balance sheet, cash, 81 million. They do have some, this is 993,000. So they have $80 million of free cash available to use. But now their free cash flow is positive. So no problem. Okay, so we're good there. Let's take a look at the forecast. We got 4 analysts covering them. And these analysts, actually 9, are putting a forecast on revenue. And you see that their revenue is going to expand at 42% for the 2026 year, 27 at 24, and then 17.8. This business is going to be a $200 million business in 3 years. Their high gross margin is going to turn into nice profit margins, turn into nice cash flow. And this PE ratio is going from 231 down to 7. But I don't think it's going to go to 7. I think the stock price is going to go up. This is, none of anything that we ever cover is investment advice. This could be a compounder. And look at this. It's down 7%. What a wild ride for this stock. I don't know if you have, can you see the after hours on this stock? Is that something you could show?
I don't know how to do that in this platform.
But you're showing some of it in today's trading because big green bar and then.
Yeah. What market's this trading on?
Delcath?
Yeah.
NASDAQ.
Okay, so yeah, the market's open, so this should be today, right?
Yeah.
Okay. Why would I need to show the aftermarket? Help me out there.
Because yesterday when I looked at the stock, it was up 26%. And right now it's down 7%. So that's a 33% swing.
Let me see if I can figure out how to do that on. Oh, I know where I can do it. I can go to so that is DCTH, and then I can go to intraday. Okay, and then I can go here. This is also stock charts, but they have 2 platforms. So
and stock charts runs on AWS.
It must. They finally put up a banner saying they were having problems with their site, but this has never stopped operating. This particular platform. Okay, so now I have the intraday.
Okay.
On there, so we're trading at 11 now, and it looks like they were. They were up 12 and they traded as high as 13 in the pre-market. Is that what you were seeing?
Yeah. Yeah.
Okay.
Just yesterday, it was up big time because somebody brought it up on the stream and we looked at it and I'm like, wow, because they released, some of their financial figures ahead of their earnings, and it really moved the stock higher. And now, man, the stock's all over the place. Now it's only down
So, yeah, I
0.7.
do see after hours, they were up to 15, and I see one blip here where they were, yeah, so it is all over the place. They were at 14 here.
Yeah. All right. Well, we'll see how it goes. Just wanted to cover that. All right. Good stuff. I think that's a good place to end. Let's take a look at the market and then we'll go from there. So looks like we are having a nice green day. NASDAQ is up. Man, really good day. And when we look at the heat map, really green day. Look at that. Meta's up 2%. Nicely done. Apple up 3%. Oof. And then the banking space, I was under pressure last week. It's doing quite well today. That looks good. Good stuff. So this week, Daryl and I plan to stream Wednesday, Friday, and we haven't settled on any watch parties this week, but next week, I think we're probably going to have at least one, maybe two. But that's our stream schedule. Anything going on with your channel worth noting?
I did put out a couple videos this week. Let me move that over here so we can see it. So I put out one on AT&T. They report tomorrow before the bell. Agree Realty, a REIT. They report before the bell. Or maybe that's on Wednesday. And then RTX is tomorrow morning before the bell. So these are 9 to 12-minute videos, and I show various charts and my own trades and trading performance and the valuation in fast graphs, etc. So I typically try to put these out for every company that I hold before earnings, just so I can anticipate what might happen with their
Excellent.
earnings.
All right, perfect. So thanks for sharing that. I'm going to review one more stock that came in, the trade desk. And we went over Applovin, so it's probably a good one to take a look at. It looks like Applovin is down, and the trade desk is catching a nice little bid. The trade desk has not had a good year. Year to date, down 55%. The 1 year, not good. And really big volatility. It was just cranking along for a while, and then it just fell off a cliff. $25 billion market cap with revenues of $2.68 billion. Its current PE is high, but forward PE is nice and low, discounted according to analysts. They have a growth rate of 23%. And I think this is what is causing the concern is the rate of revenue growth really dropped in the most recent quarter. So it's their job to see how they can start to grow. Their margins. So free cash flow looks good. You have that increasing rate of cash flow, which is exactly what I want to be seeing. Gross margins, nice and high. Perfect. Margins look good. Free cash flow yield looks good. So those fundamentals look good. Forecast. So 33 analysts are covering this stock. Plenty of opinions. One analyst is like, man, you could triple your money with this stock. The worst case scenario is you're gonna be even. with this stock. So most analysts are thinking this stock is discounted and going higher. They are going to grow at a nice clip going forward, and their profit is going to expand faster than their growth rate. So that looks good. And their price to earnings is going to drop unless the stock price goes higher. I think it's probably going to go higher. So that's the situation with Trade Desk from a fundamental perspective. I'm fairly sure their balance sheet's fine, but let's just take a peek just to make sure. Yeah, we got more cash than debt. Looks good. And I think I have the Trade Desk in. And it's discounted by 10%. Now, how did I get there? And I could probably move this to 8.5. Why is this higher than 7.5? It's because the Trade Desk is under threat from Applovin. I think we can connect the two, which is Applovin's growing and it's taking share away from competitors. Well, knowing that the Trade Desk has to deal with this high growth company that's really killing it, they're going to have to deal with Applovin for a while, right? If they're successful, they're going to have to really get much better, or they're going to be constantly under threat from Applovin. So that's why I used a higher discount rate there. They are going to grow cash flows really well. I'm actually giving them a pretty generous growth rate because they're growing top line by 16%, but the profits were going to expand better than that top line growth. So I think that's fine. So yeah, it's a nicely discounted stock. I'm just going to keep buying Applovin because Applovin's proving to be like the best at the technology, the best at getting the ads presented and giving return on investment to their customer that is using Applovin. And if Trade Desk can grow faster, they should be valued more. If Trade Desk continues to grow at their rate, I think they have a decent discount, but that's going to be my angle. Trade Desk is discounted. That's where they're at. I think I have a couple kind of together here. Here's Zeta. Zeta's a small cap. I think they're nicely discounted. Same space. And here's Applovin, discounted by 15%. And maybe these guys ought to be 8%. Well, I'm not going to believe those short sellers. Short sellers have an agenda. Let's beat up the stock through words while the fundamentals look awesome. So that's Trade Desk. Looks pretty good. It's really up to you. If you believe the business is going to outperform the expectations, you're going to do great. If you believe they're going to kind of go along the lines that are expected, I don't know. The market's already expected that this stock is not going to do well. It really did drop a lot. I mean, 55% drop is, eye-catching, while Applovin's just been killing it. So if we go App, and we can compare it to Trade Desk, they've just been opposite directions. So let's see here, the 1 year. Yep. Complete opposite directions. So that is the Trade Desk. All right. And in some markets, I think this market in particular, the benefit we have is similar to cybersecurity. You have 6-10 companies that are closely resemble each other, and you can compare them and you can say, okay, which one is going to be the best company in this space? And that for me, that influences my investing decisions. Do I want the number one player, or do I feel like I can buy the player that's in third place at a just better acquisition price? Those are decisions that you need to make. But, for me, this space gives us good comparability, as does cybersecurity, as do other industries as well. So That is the trade desk. Do you have any charts on the trade desk?
Yeah, I can show you one because I put a couple trend lines on it. I remembered we looked at this before, and these trend lines are pretty much mirror what we saw then. So we're in a confirmed downtrend. The 200-day is definitely declining. So I've connected this downtrend line to these two peaks. And that's a longer one going back to December. And then I have a shorter one just going back to August. So we could do, one more through here because it did break above that, but it moved up and then failed. So it's trying to get past this trend line at the moment. It would need to break above that before I would have any interest in pursuing this, and then I would have tight stops on it because it is in a confirmed downtrend. The RSI is above the midpoint. The MACD is bearish at the moment. And I do see a lot of stranded longs up here.
Yep. All right. Thanks for doing that, Daryl. All right, everybody. So we are going to end our stream. We went 2 hours. Geez, we covered no less than 10 stocks. Really covered a lot of ground. And we're going to need to cover a lot of ground over the next 6 weeks because it's just going to come at us with volume. So thanks for tuning in. We look forward to hopefully seeing you on Wednesday and on Friday. And in between then, we'll see if we can stream again. But this week doesn't set up for any big watch parties, I don't think. But I'll take a look at the calendar again and see if maybe I was wrong about that. Everybody have a terrific day. Good luck this week. Looks like we're going to get off on the right foot this week with stocks going up. And hopefully you're making lots of money this today and this week. Thanks, everyone.
Take care, everyone.